The S&P 500 closed at an all-time high today, not near one, at 1. And about 90 minutes later, AMD reported a quarter that beat on revenue, beat on earnings, and raised guidance, and the stock fell nearly 9%.
Both true. Same afternoon. And let me be precise, because yesterday we were careful to say the Dow was knocking on the door rather than through it. Today is different. SPY closed at 771.33, the highest close in its history, and printed its highest intraday level ever at 773.41. No hedging needed. That is a record on both measures.
And what got it there is the thing that has been missing for weeks.
The chips. Yesterday, the index reached the door without them. Today, they led enormously. So we have two puzzles worth solving. Why semiconductors had their best day of the year on a story about a shipping lane, and why a company that beat and raised got sold. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Set the scale, because the numbers underneath were not subtle.
The Dow closed at 54,085.88, up 1.71%. The S&P 500 at 7,736.52, up 1.79. The Nasdaq Composite at 26,584.99, up 2.59. And the Semiconductor Index, the SOX, closed at 12,179.26, up 6.55%. Its single best session of the year.
6.5% on an index in one day. That is a number you normally see in a crisis, not on a record close.
That is the right instinct. Moves that size are usually panic in one direction or the other. But the VIX finished at 1650, so this was not a volatility event. It was concentrated, aggressive buying in one part of the market.
One footnote to keep today honest. The Nasdaq 100, QQQ, closed at 723.85, up 3.4%, and it is still about 3% below its own record close. So the S&P made a record. Large cap tech as a group has not.
Yesterday, we spent an episode on a single gap, the Dow 0.2 from its high, while semiconductors sat 22% below theirs. We asked whether that was healthy breadth or the market abandoning the fast horses.
And today, we got a partial answer.
Partial. The gap narrowed sharply. Semis up 6.5% against under 2 for the broad index, but it did not close. The SOX is still roughly 17% below its own high, even after its best day of the year.
So one day of catch-up does not undo a 22% hole.
It takes it to about 17. Real progress, genuinely constructive, but the divergence still exists. What changed is the direction of travel, not the destination. And the trigger is uncomfortable. The best semiconductor session of the year was not caused by a chip earnings report. It was caused by a comment about a shipping lane.
Walk through that, because this is the discipline beat of the episode.
Oil fell hard. WTI down 6.2% to $75.36. Brent down 5.6% to $79.08. Both now roughly 37% below their 52-week highs. The catalyst was the Treasury Secretary saying a deal could come Tuesday or Wednesday, giving commercial shipping freedom of movement through the Strait of Hormuz.
Could come, not has come.
And that distinction is the whole point. Nothing has been signed or published. The Secretary of State was noticeably more cautious than the Treasury Secretary. His framing was that talks with Oman are progressing, not finished.
So, separate confirmed from traded. Confirmed. The U.S. and regional mediators want safe transit restored. Iran acknowledges talks with Oman. Qatar is mediating.
And the parts being traded as settled are draft terms. Shipping channels, who administers the strait, a service fee split with Oman. Those are reported only, and the reported versions do not agree with each other. The market priced a completed agreement off a scheduling comment,
which sets up a specific risk into Wednesday.
If nothing lands, today's move is the one that unwinds. And today's move was the best semiconductor day of the year.
Then the close came, and AMD reported. The actual numbers first, before any interpretation.
Revenue $11.54 billion, up 50%, against about $11.28 billion expected. Adjusted earnings, $1.66 a share against $1.62. Data center revenue, $6.72 billion, up 107%. Free cash flow, $1.56 billion.
Data center more than doubled.
More than doubled. And guidance went up. AMD guided third-quarter revenue to about $13 billion, plus or minus $300 million, roughly 41% growth year-over-year at the midpoint, 13% sequentially, with adjusted gross margin around 56%.
So a beat on both lines, a doubling in the most important segment, and raised guidance. And the stock fell 8.8% after hours, with the low beyond down 10.
That is the puzzle. And I want to resist the lazy answer, that something must have been hidden in the report. There are two better explanations, and one honest correction. Start with what happened before the print, not in it. AMD closed the regular session up exactly 7%. It went into its own earnings having already rallied 7% that day.
So the market had already bought the good quarter.
Already paid for it. And there is a market-wide statistic that frames this, from FactSet. This quarter, S&P 500 companies that beat earnings estimates have moved an average of plus 0.1%. The 5-year average reaction to a beat is plus 1%.
So a beat is currently worth about 1/10 of what it normally is.
On average. Good news is being priced in advance. And if the typical reward for beating is 0.1%, a stock that has already run 7% into the print has borrowed far more than the result can repay. The report is not the event anymore. The positioning going into it is.
And that is worth carrying forward, because it is not about AMD.
It is a description of the whole earnings season. When expectations are fully funded before the release, a good number is not a catalyst. It is a settlement.
You said there was an honest correction. Let us do it, because I have seen the opposite claim all evening.
2. The first concerns that 50% growth rate. There was an $800 million charge tied to MI308 export controls. A lot of commentary tonight places that charge in this quarter and concludes AMD should have earned even more. That is backwards. AMD's own footnote puts it in the second quarter of 2025.
The comparison period.
Which means it depressed last year's base, not this year's result. The plus 50% is real as reported, but part of it comes from an unusually weak quarter a year ago. That is the difference between an accurate read and a wrong one.
And the second?
AMD did not guide to earnings per share. You will see a figure of $1.93 attached to the third quarter tonight. That is analyst consensus, not company guidance. AMD guided revenue and gross margin. Attributing an EPS target to management that management never gave is how a stock gets judged against a number it never promised.
Put the fall in proportion, because 9% sounds like a verdict.
Do the arithmetic. AMD closed at 518.58. Apply the after-hours decline of 8.8%, and you land at roughly 472.94. Now look at where it closed last Friday, 476.15.
So the entire after-hours collapse takes it back to Friday.
Slightly below Friday. The move being described as a crash unwinds about 2 sessions, and even before the drop, AMD was about 11% below its 52-week high, set on June 30th. After the drop, roughly 19% below it.
That is very different from a stock making new highs and then breaking.
Completely different. This is not a company that ran to a record and got rejected. It ran 7% in a day, inside an existing drawdown, and gave that day back. Now, the constructive reading, and I label it a reading, not a fact. A business growing data center revenue at 107%, guiding up and generating $1.5 billion in free cash flow, whose stock digests a one-day spike rather than extending it, may be better positioned to advance further than one that goes vertical with nothing left.
And the counter?
Consolidation and deterioration look identical for the first few days. What separates them is whether it gets bought tomorrow morning. That is the test, and we do not have it yet.
Here's what makes tonight informative, rather than just a bad print. AMD was not the only chip-adjacent company reporting.
Arista Networks reported the same night. Revenue $3.04 billion, up 37.7% against $2.83 billion expected. Earnings $1.02 against 89 cents. Operating margin just under 50%. Full-year outlook raised to $12.6 billion, about 40% growth.
And the reaction?
Up 10.3% after hours. Same night, same tape, same hour. Both beat, both raised. One fell 9% and the other rose 10.
That is about as close to a controlled experiment as markets ever give you.
And it removes the easy explanations. Not the macro. They shared it. Not the hour. Not the sector mood. And one detail sharpens it further. Arista closed the regular session at 190.51, which is a record close, then rose another 10% on top. AMD closed 11% below its high and fell.
So the stock at a record got rewarded, and the stock in a drawdown got punished. That is the opposite of what positioning alone would predict.
Which tells you something is being actively chosen, not just unwound. Arista is networking. AMD is compute. On the same night, compute beat and got sold while networking beat and got bought. That is not a verdict on chips. That is money moving one layer down the stack, out of the processors and into what connects them.
The obvious question, semis up 6.5%, optical names up 8 to 19 in a session. Is this overheating?
The data gives a surprisingly clear answer. After today's rally, look at where these sit against their own 52-week highs. Applied Optoelectronics is still down 43.7%. Marvell down 33.7%. Coherent down 26.4%. Lumentum down 21.8%. The Semiconductor ETF down 17.3%. NVIDIA down 10.4%.
Everyone's still in a deep hole after a day like that.
Now the other side of the same table, which explains the violence. Measured from their 52-week lows, Applied Optoelectronics is up over 600%. Lumentum about 700. Coherent nearly 300. Marvell over 250.
So these went vertical, broke, and are now rallying inside the wreckage.
That is the shape. Applied Optoelectronics went from about $18 to $233, then roughly halved. So today is not a blow-off top at a record. It is a violent recovery in a complex that already had its mania and its crash within the last 12 months. Those are different risks. A blow-off at a record is late. A bounce inside a drawdown is either early or a trap.
And the one name actually at its high?
Arista. 2% off. And that was before the after-hours move. Which brings us back to the same conclusion from a different direction. The market is paying record prices for interconnect, while compute, memory, and optical components all still trade well below theirs.
The actual moves, because they were not evenly distributed.
Applied Optoelectronics up 19.44%. Marvell up 12.80%. Coherent up 12.35%. Lumentum up 8.92%. The Semiconductor ETF up 6.80%. And NVIDIA, the biggest name in AI, up 2.56%.
So optical ran 2 to 3 times the chip index and 5 times NVIDIA.
That is not a chip rally. A chip rally lifts NVIDIA. This was a specific address, and 3 things converged on it. The concrete one. NVIDIA has begun mass production of co-packaged optics. Senior Vice President Gilad Shainer confirmed it on August 3rd. Spectrum X co-packaged optics switches shipping to customers and deploying in NVIDIA's own facilities, tied to the Vera Rubin platform.
Why does that matter enough to move a whole subsector?
Because it cuts optical power consumption roughly 70% per port. In a data center where power is the binding constraint, a 70% reduction on a component you deploy tens of thousands of is not an efficiency gain. It changes what you can build.
The second thing?
A proposed U.S. ban on Chinese optical imports. And be careful here. That is a proposal, not policy, not enacted. The market traded it anyway. The third is worth the rest of the episode. Lumentum's chief executive said the indium phosphide laser shortage for AI will be more severe than the memory crisis.
More severe than memory. That is a strong claim, given what memory pricing has done this year.
It is his claim, not an established fact, so hold it as well-informed opinion from someone with direct visibility. But the supply picture underneath it is verifiable. Indium phosphide is the material the lasers are made from. High-speed optics need lasers. No indium phosphide, no optics.
And who controls it?
China refines roughly 70% of the world's indium and placed indium phosphide substrates under export control in February of 2025. 6-inch wafer prices spiked afterwards. Lumentum is booked into 2028.
Everyone learned the word HBM this year.
The next word is indium phosphide. And notice the structure, because this is the part that lasts. The United States is considering restricting finished Chinese optical modules. China already restricts the upstream substrate those modules are built from. Both sides now hold a choke point on the same supply chain.
So, what is the likely consequence?
Not that either side stops. It is that the United States increasingly chooses security over efficiency, accepting slower, more expensive data centers rather than depending on a rival supply chain. And we should be fair about the cost, because it is real. American firms have the technology, but not the scale. Coherent and Lumentum lead in lasers and silicon photonics and are well behind Chinese manufacturers in high-volume module assembly. Requalifying a supplier for a hyperscaler takes months, sometimes more than a year.
So the friction has a price, and someone pays it.
Someone always does. That is the honest version, and it is why this segment matters more in 6 months than tonight's earnings reaction does.
Three things to close, then the calendar.
First, a new memory format. SK Hynix and SanDisk published the first high-bandwidth flash standard, NAND-based, sitting between HBM and an SSD, up to 512 gigaband bandwidth of 0.4 to 3.0 terabytes per second, an open standard through the Open Compute Project, with Google and Tenstorrent in the consortium. Commercialization timing is not committed to any date. It is an attempt to relieve the memory bottleneck using NAND economics, and SanDisk reports Wednesday the first chance to hear how real it is.
Second,
SpaceX reported its first public quarter. Revenue $7.81 billion, up 92%, and adjusted EBITDA of $3.54 billion. But read it carefully. This is a GAAP net loss, and adjusted EBITDA is not profit. Capital expenditure was $18.37 billion in a single quarter against $7.81 billion of revenue. Starlink is the only segment making money. The AI segment lost $1.26 billion at the operating line and consumed $15.83 billion of that capex.
and the stock?
Closed up 9.43%, then fell about 7.5% after hours. The first lockup tranche becomes eligible around August 6th, up to 911.5 million shares, against an IPO that sold about 639 million, including the full greenshoe. But eligible to sell is not sold, and it is not new issuance.
Third,
Precious metals rallied alongside equities while oil collapsed. Gold up 2.41%, silver up 4.13%, platinum up 8.29%. That is not a clean risk on tape. Something is still being hedged.
so what settles all of this?
3 things. Does a Hormuz agreement actually get signed Wednesday? Because oil, and by extension today's semiconductor rally, is priced for it. Does AMD's after-hours drop get absorbed in the morning, which is the difference between consolidation and deterioration? And do SanDisk and Western Digital confirm memory demand is as strong as pricing implies?
And the honest summary of the day.
The S&P set a record, and it took the best semiconductor session of the year to get there, driven by an agreement that does not yet exist. Underneath it, money kept moving down the stack, out of compute, and into what connects it. AMD's quarter was strong, and its stock gave back 2 days. Those are separate sentences, and tonight the temptation is to collapse them into one.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.